Is there any new kind of technology that you're using that you think has been really impactful recently?
I think a lot of conversations are around foundational software. So when you talk about AI, right, it's not about whether you have AI on your platform, it's about who's using AI, right? So, and it's more about Facebook is not going to create a platform for their AI. They're going to embed it based on a platform that already exists. The question is, who are those companies going to be? And that's where you want to be investing your money. The other pieces are around, again, foundational software in the educational technology sector. That's going to be a great spot to be as well. When you start thinking about healthcare or med tech, the question there right now, it's very saturated. There's going to be some consolidation there. And then what is
on the software side?
I'm sorry, software. Sorry, I did get too far. But on the software side, yes, it's going to be.
You think
AI.
that the med tech area is a little?
I do think med tech and healthcare, right? They're poised right now for a little consolidation. There's a lot. Yeah, there's a lot.
That's awesome.
Yeah.
Good, that's good insight. No, I love it. I think that's great insight. That's what we want to hear.
And I would say technology is rippling through both the companies that we hold through our partnerships and our own companies. So on the heritage side, technology has made it more efficient and helpful. I would say one way it's impacted us is it's made our due diligence easier or more thorough, right? So I can give you an example of, we do background checks. Personal background checks on all the people we invest with. Prior to working at Heritage, I did a lot of personal investing and I didn't do that step, right? But we're doing that for our clients and we've had deals that we loved the investment narrative, but that background check came back and uncovered some things that we dug into and we passed because we didn't feel comfortable with that operator at that point in time. So yeah, technology is helping everything. It's made our due diligence process, I'd say, easy for us to get that transparency we want with those partnerships that we're making.
Do you have a due diligence team, or how do you do that?
We do. More than anything, if you look at how many investments we're doing a year, we're not doing 50, right? We're making 5 to 7 to 10 allocations. So we don't need a massive team to execute on that. What we have is a defined process, and this addresses one of the other questions you asked to be prepared for. I would say, one of the things that's been impressed upon me over the last 3 years is the importance of separating investment diligence from operational due diligence. So prior to joining Heritage, all I ever cared about was what's the good narrative. That's a killer story. To your point, tech for tech's sake. Hey, that's a really cool piece of technology. But once you get past the investment narrative, which many of us in this room might be good at, operational due diligence. How granular do you go in the fund docs? How do you get into the backgrounds of the GPs? How do you get into the weeds of what they're doing? We've had multiple deals where we loved the investment narrative and the due diligence. We thought they'll probably make money, but operationally we discovered, hey, you know what? They did something really funky here. Instead of being an LP, they were an LLC, which means they can give disparate economics to their investors. We're a pass on that. Red flags will pop up. And so process has been more important than depth of team. We've got a 156 question checklist we go through. And, and what's cool about PE is you have time for that, right? So when I was in real estate, which was my background before joining Heritage, you have 30 days of due diligence.
Yeah, right, sure.
And we spent 7 months on one operator, right? Just to get to and then we're like, okay, now it's ready. So I do like that element of PE.
How can obviously a family office through, going to you can get that level. If I'm not, how am I doing it?
Wow, if you're not, how are you doing it? Yeah, that's a great question.
So one comment on that is that when I was in my last private equity role and I joined the portfolio org of Alpine, we didn't have an operational checklist of the companies we were purchasing. Like they were looking at all the financials, and when you acquire it, all of a sudden, everything that you thought they'd start performing on starts to fall apart. So we built that operational checklist, and actually in this venture fund, we're looking to do this very intrusive due diligence, like technical, commercial, financial, because we'd only want to partner with people that are willing to, open kimono, so to speak, because that's what's going to allow an operating partnership. And yeah, to your point, there's DDQ docs out there, but like you have to figure out, depending on what your strategy is and where you're investing, how much of that you want to build.
Yeah.
Michael, how did you do that with your family office starting out? How do you, obviously now you've built a team and maybe you guys already always had the team, but can you describe that?
Yeah, so I think to kind of piggyback of what they're saying, I think having industry experience in what you're investing in is critical. So, I mean, we're oil and gas folks before we were a family office. That's how we all were trained up. We were on the drilling rigs. We were working on the business development side. And so I think it's being able to ask those operational questions and understanding, what's the infrastructure on the ground of just, yeah, we think there's a lot of potential oil here, but we may not be able to actually go access it because of marketing issues on the midstream side, or our first purchaser is actually charging us, $4 extra per barrel to do something that you may not know if you don't actually dive into kind of the operational side. And I think that's critical when you're doing this type of kind of granular due diligence, is kind of understanding the full swath of what you're actually investing in. And again, luckily for us, we all come from an oil and gas background, so it really helps when we go through that process because we're not trying to learn a new market.
Yeah, that's great. What's kind of your investor in your, if we could go down the list, like who are your investors and who's the largest?
Before we go into that,
yeah,
I was
sure,
just gonna
please.
say, just to put on the management consulting lens for a minute.
Yeah.
Don't be afraid to ask for help. If you are a family office and you don't know something about a certain industry,
Yeah.
there are plenty of people that do. I think that's one of those things that I think there's a lot of pride sometimes, people feeling they have to do it themselves. There's a lot of experts out there. Even once in a while, I'll say, you know what, I know so-and-so did this for 25 years. Why don't I ask them about this? Right? And so
Yeah.
I think there's something about that being humble enough to ask.
Well, that's great. What would be your investor avatar, and what is kind of the largest investor that you have? You don't have to name names, but just...
Yeah, I would say our largest investor are the small family offices. One of the benefits is, as you guys I'm sure heard today about investing in oil and gas, is the tax benefits, not just on the passive income side, but on the active income side, especially if you, for the first 12 months while capital's being deployed, come in on the GP side. So generally it's smaller family offices who are looking to take a bigger chunk out of a project. We don't tend to get too big with our fund sizes, but also kind of on the individual size, it's someone who's generally a high net worth W-2 individual who's looking to offset those high net, those high W-2 earning incomes. Usually it's someone living in California or New York who's got a tax bill that is, why cut a check to the federal government when you can cut a check into a business that's going to give you a little bit of or going to give you some passive income, give you those tax deductions, but also give you an equity stake in a project that will last, 10, 15 years.
That's great.
And just remember, we focus primarily on M&A. So with that said, we work with companies and with family offices. And so we worked with companies as large as worth $1 billion or more. So, and families, 9 figures, right? So for us, there is some consistency around that, but the other piece is too around expertise, whether or not they want to have a big portfolio, things that they're looking for. But yes, M&A is definitely a very different transaction.
Yeah, we predominantly work with families who have less than 250 million in assets. We manage 70 million for one family. In this fund specifically, that targets lower middle market private equity. We have a $5 million investor in there. The minimum there's $1 million. But it's really people who are saying, I want access to that space in a diversified way, and I don't want to put 50 million of my own money just to hit fund minimums to get there.
Yeah, similarly, mainly family offices. This model is new. It's unique. It's kind of bridging a little bit of the side that venture hasn't quite delivered on the funds they've created, and then taking a PE approach into this area where we do want to support innovations. So the type of LP profile or family office profile has to sort of, there has to be strong alignment in like what we're trying to achieve. And our investors so far, family offices, roughly 250 to 500 million in AUM.
What advice do you have for the private investors here today who might be interested in your space, or maybe it's a family that has a deal that they're thinking about divesting, or maybe how do they bring it internally to take on new opportunities? So if for the people who are here today, like what would you say, this is how I can help you directly?
Well, I guess I'll start. I would say ask a lot of questions about what assumptions they're making in their models. Oil and gas is a subject that the average retail or small family office investor doesn't really know much about. And there can be, my dad used to always say, if you can't baffle them with brilliance, bury them in you know what. And so sometimes you can get a lot of bury them in BS when you start throwing, really fancy models out at you. I mean, I was an engineer, now I'm on the finance side, and trust me, you can build the most complex Excel model that you want, but 4 to 5 key assumptions made to the upside can completely change the way the model acts. And, I can get a model to tell you whatever you want. So we can work backwards from the outcome if we really want. But the key is, what are you underwriting and what are those assumptions you're actually making? And really ask those questions, because if you're not asking that of your sponsor, they may or may not tell you.
For me, I would say it's plug. Tomorrow at 10:40 a.m., we'll be talking about that, acquiring and divesting companies.
Right.
But the other side of that too, when you think about from a divesting standpoint, a lot of family offices tend to hold on to companies forever, right? They just buy and hold. One of the things you want to start with is think about the strategy off the bat and thinking about, okay, what do we want to be in the next few years? And at what point is enough? What kind of performance metrics are we looking to hit? What does an exit strategy look like for each of these holdings? And that's something you want to be thinking about when you think about M&A in particular. When you think about acquiring, again, it also has to align with your thesis on who you want to be and your vision going forward.
With uncertainty in the market, does it make it better to be, is it better to sell now, or is it like with the uncertainty in the market, is it better to let's ride the wave and see where the optimal is?
I love this question. You know what? There's winners in every single marketplace. And I always say, no matter what the economy is doing, if it's good or bad, there's always somebody winning, right? In every industry. Mm-hmm. So if you believe in what you're doing and you have a great product or you have a great company that's winning, then yes, it's probably a great time to sell, or either hold on and ride it and then sell later. But that's a good time to get your cash if you're looking to exit. But yeah, I love that question.
Yeah, I would say, for people here in the room who are deciding whether or not to start their own family office, or if they have their own family office, if you have $250 million or less, it's an interesting question to ask is, should I do this? Should I start my own family office? Should I go hire 6 to 8 people who are professionals with diverse backgrounds and really run a brand new company, or not? While no one can answer that for you, I can tell you there's power in partnering with groups like ours, who don't only get a single look and have a single perspective that you may have, but we have multiple families with multiple experiences and expertises and networks. And leveraging that can be wise. I would say, in addition to some of the niche investing, which we do, the tax planning and tax strategies, which plug 11:30 tomorrow, I'm going to talk a little bit more about, can be massive. And there are actually tax tools out there that you cannot legally do by yourself that require a third party like us. And they add up to tens of millions of hard dollar savings in your pocket. So yeah, I think that's an interesting decision everyone's got to make for themselves. And if it's a conversation you want to have, we'd love to have it.
Anush?
Yeah, it's like this question as well. One of the single biggest comments I've gotten from both family offices and institutional LPs, or actually a comment rather, is that they haven't been very happy with the lack of transparency from their fund managers, especially the last tranche of emerging fund managers. And so that's actually one of the things we provide because of our intimate working relationships with our startups. So the idea here is that there has to be alignment. Again, I know that word's been used a few times, but the idea is an alignment in the strategy, alignment in what you're looking for in terms of a fund return, in terms of the value creation, and we thereby create this, not only intimate relationship with startups, but we want our cohort of LPs to really understand what's going on, be aware of things that are coming up, and are able to get ahead of things, and more collaborative than anything.
Are there, well, I'm going to ask one more question, but I thought I'd first ask the audience, does anyone have a question that they'd like answered? And perhaps Charlie and Xander can run around. Go ahead and raise your hand if so. And while that's happening, if you've been to our events before, you've heard this question, what's the one piece of $1 million advice that you could tell the people in here that you can look at was a single mistake you made that here's the lesson from that. So when you look at your history, what was one thing that this is how I would do it differently today?
Oh man. I mean, if you've been investing as long time as we have, you're always going to have some swings and misses. I would think stick to your strategy. And, for us, we have a specific, even niche strategy within oil and gas. We tend to avoid some of the more complex horizontal drilling. Our focus is really on unconventional vertical drilling. And I think the times we've gotten in trouble is when we've varied away from that. I think the times when we've moved into more of an exploratory mode, I think has proved somewhat fruitful. But I think, specifically over the long term with our strategy is not, and trying not to get caught up in the new hot thing. I think we've done a good job of that over the years, but I think every time we've kind of gotten bit a little bit is because we've maybe strayed from what that strategy was that has made us successful for so long.
I mean, for me, I think I double down on culture matters. And I think the idea of when you think about a company, when you think about, do you get along with do you get along with the owner? Does the owner have a good strategy? If you're looking to buy their company, if you are the owner, the question is, are your people going to actually keep things moving in the right way? Do you have a second line of defense that's going to be really good at taking over the company? These are things that really do matter because it is about, in the short run, sometimes it's about the dollars, but that's not really what a transaction is about, right? It's about legacy and it's about long-term viability.
Yeah, I'd say something we see a lot is, I think one of the learning is intellect does not necessarily qualify someone to be good at managing money. Everyone in this room is smart. Not everyone in this room is really good at managing their own money. They're all good at something, right? We're all experts at something. And we run into this a lot. People who are former masters of the universe, they're the world's best shoe salesman. That doesn't necessarily make you good at investing $50 million that you got from your liquidity event. So understand the distinction between being really smart and really good at something and then having a team.
Yeah, I think that having the ability to focus on your strategy and whatever you've picked in terms of what you're planning to do, like setting those parameters ahead of time and not really straying from it, and focus. The power of focus is not really about saying no to things. It's about saying no to things that could be really, really good, but it's not aligned with the vision you've laid out. That's really hard to do.
Yeah, that's a real discipline. Yeah. We do have one question that I saw. Go ahead, Charlie.
Hey, so now we're coming. Is this on? Okay. Paul Graham here. Curious to think of, as we think of niched investment strategies, what have you maybe not shared that you think would be beneficial for us to take away and know?
Oh gosh, 2 words, carbon credits, but that's what I'll say.
I think IT services companies, that's a strong area for growth right now.
So this whole boomer retiree wave and ways to ride that. If you've heard the term search fund, that's a very interesting space for us, of which we're active investors. We can talk more about that offline at a table if you want.
Yeah, I think, in general, always like services businesses. You can provide cash flow, liquidity, and, we push our startups to think about getting that exit pathway as well, right? Not only just building huge valuations, but getting to consistent liquidity, I think, in these markets is more important than ever.
Yeah, that's great. Listen, can everyone give a big round of applause to this panel? What a great panel. Thank you so much.